Hey guys, welcome back to the channel, and this is week 35 of my TFSA portfolio. And today we're talking about all the stocks that I bought this past week, including one new position, which we'll go into later on this video. But if you guys are new here, my name is Daniel, and here on this channel, we talk about stock market investing. And this series specifically is me taking a TFSA portfolio starting with $2,000 this past March and trying to grow it in 3 years to $50,000. Every single week, I deposit $200 and continue to dollar cost average into the various positions I hold in this portfolio. The major advantage into dollar cost averaging is not being screwed over if I bought in at a high point. Because I'm buying in pretty much every single week, I can see which stocks are down on the average or which stocks are up and just choose the ones that are down overall. That's pretty much as simple as it is. And honestly, anyone can do this. All you have to do is spend a bit of time and research some of these stocks and just see which companies have been around for a while and that are relatively trustworthy. Also, allocate your money into stocks that you feel comfortable in terms of risk. In my portfolio, I have both dividend as well as growth stocks. I rank all my positions by risk, keeping a third of them in high growth stocks, a third of it in medium stocks, as well as a third of it in low risk stocks. I also make sure to have some dividend stocks as well as some non-dividend stocks. Investing isn't meant to be difficult, and if you want, you can start today and get $50 for free from Wealthsimple Trade if you sign up using the link down below. Subscribe if you want to follow along my journey into 2024, where we hopefully will hit $50,000 in this portfolio. Currently, the portfolio sits at $9,600, so let's jump right into my computer and see what's in the portfolio and what I bought this past week. Now, taking a look at the statistics of this portfolio, the total market value is $9,625.35. If we look at the risk spread of this portfolio, I have about 20% in high risk stocks, 39% in low risk stocks, and 40.9% in medium risk stocks. About half my positions pay dividends while the other half doesn't. And this is an allocation of all the different companies that I own and what percentage of the portfolio they make up. Currently, this portfolio is up by 8.41% since I started this portfolio. The total dollar gain is $746.92. If we compare my portfolio to the TSX index, if I were to invest in the TSX index instead of all these positions here, then currently my portfolio is underperforming the index. However, this fluctuates on a week-to-week basis. So this week I'm down by 1.77%. Next week I could be up. Now, if we go over to the transactions tab, we can see all the different positions that I bought this past week. And you can see that I bought one share of Enghouse Systems at $53.85, 2 shares of Power Corp Canada at $42.71, 2 shares of RioCan for $22.76, 2 shares of D2L at $17.09, and 5 shares of Well Health Technologies at $6.65. D2L is a new investment of mine as they just IPO'd this past week, and they IPO'd at a price of $17. However, if we go over to their chart, the company IPO'd on November 3rd, and they closed the day at $16.75. They quickly took a dive down to $16.45 before recovering to its approximate IPO price of $17. And today it's trading underneath its IPO price at $16.86. And my plan for this position is to slowly average in, because honestly right now, it's very difficult to get a feel where the market believes D2L's value is. So for that reason, I'm not jumping right into the stock, and that's why I only bought 2 shares, or a total of $34.18, which is very small compared to the entire value of this portfolio at $9,600. So right now, D2L sits at the lowest value position in this portfolio. So sorting this by current market cap, again, my top position, just like last week, is TD Bank, $932, and I'm up 11% on that. Next, followed by Power Corp Canada, which I continue to buy as it's under its net asset value of $50 per share. Enghouse Systems, the reason why I bought into this week, as you can see, my cost per share is $57.53. And when it was sitting at $53, it was trading at a discount of roughly 10% compared to my cost basis. And this company also pays a dividend of 1.21%. It's a technology stock and continues to grow, and it did see a bit of a tumble recently. So looking at Enghouse stock here, we can see that Enchos over the past 5 years, it peaked at $80 or $77.55. And right now it's on a dip of 27%. So for that reason, I'm continuing to buy into Enchos as long as it sits below my cost basis. Around the $53 mark is where I'll continue adding shares. The Bitcoin ETF, right now it's on a bit of a slump compared to last week, but I'm still up by 43%. Air Canada has been it was doing well last week. However, it's been slowly dropping. And I did say in my previous video last week that I believe that Air Canada just had a little bit of a pop just because of the whole recovery play and people are doing more air travel. But I think in the medium term, we're going to see a bit more turmoil in the stock and it might drop back down to the $23 or $22 level. And I think capturing more shares there is where I'll continue to add to this position. Kinaxis, looking at a 1 week performance, it's the second biggest performer in this portfolio. It's up by 5%, or in total, I'm up 50% on this position. I personally don't plan to add much more to this position as long as it's trading near all-time highs. Maybe if it drops below the 170 mark, that's where I'll continue to add to this. But right now, Kinaxis is a stock that's fluctuating quite a bit. With supply chain woes and people trying to figure out what to do, this is a good tailwind for Kinaxis. However, this stock is trading at quite a big premium right now. The other stock that did very well this week is Shopify. This stock I was buying in the 1700s or even high 1600s. And I was telling you guys, I'm buying the stock because over the long term, I think it will do well. Honestly, I was not expecting it to pop up past $2,000 that soon. So for now, I will be holding off on buying this and just seeing where the stock goes. Again, Shopify is another stock like Kinaxis that is priced at a huge premium. So this stock is very volatile all the time. Right now it's on an upswing and it could be on a downswing in the next couple of months or so. Who knows? But for the time being, I'm holding this position and we'll see where I continue adding more. Now narrowing in on the two other positions that I bought into this past week are Ryokan and Well Health Technologies. Well Health is a position that I mentioned before. Anything under $7, especially in the 660 mark or so, is a place where I will continue to add to this position. Right now I'm down 9%, but that's no big deal to me. This is a 3-year portfolio and I'll probably continue holding Well Health Technologies past the 3-year mark. Ryokan is a reopening play as shops continue to reopen as well as businesses continue to do well as people come back into the stores. I think we'll see a recovery in the stock. We can see that Ryokan is down from its all-time highs of $27 in the past 5 years. If we look at the entire history of Ryokan, we can see that Ryokan once touched about $30 per share. Right now, the P ratio is sitting at around 15, which is reasonable based on where interest rates are. On top of that, its dividend yield is 4.23%, so it's paying a pretty decent dividend, especially those who follow the 4% rule. Now let's hop back over to the camera and talk a bit more about D2L. The main reason I bought into D2L is because I think there's a high margin of safety buying in at these prices. What I mean by that is when I compare D2L to its competitors like Instructure Holdings as well as Docebo, its PS ratio is extremely cheap compared to the other ones. Its PS ratio sits around a 3 or a 4 for D2L. Docebo sits around a 15 to 20 on average, and Instructure Holdings is around an 8 or a 9. So D2L is half of that of Instructure Holdings, and Instructure Holdings basically sells a very similar type of platform to D2L. Docebo is a bit more focused on corporate learning, so maybe that's why investors are giving it a higher multiple in its price to sales ratio. But nonetheless, D2L compared to these two stocks is very cheap. I do a deeper dive into D2L in another video, so I'll have the link in the description down below, as well as at the end of this video, I'll have that video pop up on the screen. Another thing that I have a bit of an advantage over most of you guys who are watching this video is that D2L is located in my hometown. And there's many people that I know that have worked at D2L and are still working there. A few friends of mine have worked there for 10 or 15 years and they've been with the company. And that's kind of a testament to how great a company it is, that people are willing to stay that long at the company and continue to work for them. And they've moved up in the ranks in the company in the meantime. And in fact, my wife actually worked there for about an 8-month contract. And just hearing what she had to say about the internal team, at least the design team of D2L, gives me confidence that the tech team in D2L knows what they're doing. The company has a very methodical strategy when it comes to their user design. They think everything through and don't just throw whatever sticks to the wall. There's a ton of research that's conducted to inform their product decisions. And that's why a lot of Canadian universities use their platform, as well as many of them in the States. And they're continuing to grow in this industry. The market's currently very fragmented for learning management systems, which is the product that D2L makes. Basically, if you go to university, all your assignments and grades are put onto this website, which you can log into and see. Teachers also put out additional material onto this learning management system, which can be distributed instantly to students. And that's the power of the learning management system that D2L is creating. On top of that, they can even record lectures and put them up on there so that students don't necessarily have to go to class, or they can take courses online. This saves universities costs in terms of needing classroom space, as well as the material that's used for these lectures can be reused from term to term. That way the professor doesn't need to spend time delivering the exact same lecture. Instead, he can reuse it and spend his time elsewhere in terms of research for the university that's more profitable. D2L also has a corporate side to the learning management system, so they're a direct competitor to Docebo. And the fact that they've started out in the education space, I think gives them a bit of an advantage, because people going through the education system, they'll be used to the Brightspace platform, which is the name that D2L gives to the learning management system. When students go from the education realm into the corporate world and they move up in ranks and they're making decisions about which platforms to choose for the learning management system in a company, they'll definitely remember their experience with D2L and the Brightspace platform and likely recommend it down the road. So the fact that D2L is penetrating the users at a young age and just getting them used to how they do things or their design, as well as the user experience, then when they move into the corporate world, they might find frustrations with the current LMSs out there and recommend that they switch over to Brightspace. Now, this is just a hypothesis, and we'll have to see if this plays out over the next 10 to 15 years, because people who are graduating university right now won't immediately move up into higher management positions that make these decisions, but eventually they will. Now, to not let this video drag on, I'm going to end it here, and if you guys want, you can check out my D2L analysis, which is one of the videos thrown up on the screen. The other video is there as well. If you're there, I'll see you there. If not, keep up the grind and have a great day.